Okay, without further ado, let's convene this precious metals panel and welcome to the World Outlook Forum. We have today 4 specialists in the precious metals sector, and I'd like to briefly introduce them and then give you the format for today's panel discussion. So on my immediate left, a person who absolutely needs no introduction, Michael Levy from Border Gold. Started the business in 1967. I haven't had a chance to ask him how much gold he's got tucked away, but we might have that chance. Next to Michael is Darren Klink. Darren's background is in business and finance, and he runs a gold developer by the name of Bluestone Resources. Following Darren is Scott Eldridge, and he's the CEO of Gold Explorer and developer, Canark Resource. And last but not least, on the far left, we have Chris Taylor, who runs a very exciting discovery company in the gold business called Great Bear. So the format today is that we've pre-planned 3 questions for each of the panelists. We've got about a half an hour. So I'm going to start the first question here with Michael, and we'll just go down to the end. I'll start the second question at Chris and come back, and again on the third one we'll go back down towards Chris. So without further ado, the first question is really to do with the overview of the gold market. Specifically, Michael, what is your view on the current and future market outlook for gold?
Well, first of all, when you said 1967, I want to let you know you made me feel really old, okay? There are people in this room that weren't born when I started in this business. The outlook for the precious metals is extremely bullish, and I'll give you a couple reasons why. First of all, interest rates are at record lows. And when interest rates are at record lows, you cannot earn money in the bond market if you're just buying for the interest rate in the treasury bill market. Your bank pays no interest. So part of your cash has to be, and I say has to be from all the years I've spent in this business, and should be in precious metals. Precious metals are cash, gold is cash, or turned into cash instantly. And if your money is sitting and not earning anything, except for your money that's in the equity markets, and that's good, and it's been great, and it'll probably carry on being good, but your cash, that's your protection. And people put away cash for protection. They keep this nest egg of cash. Well, keep your nest egg in something that is going to move up. And the reason it's going to move up is because of the degradation of currencies. It's being degraded in the United States. Interest rates have come down. They're going to come down further. Bank of Canada is going to bring down Canadian interest rates. European rates are at 0 or minus. And I just think that every single one of you here who owns shares in the market should also have a piece of that investment in precious metals. It's your life insurance policy. It's your safe haven. And to me, and has been throughout the years, and I'm not lecturing anybody here, I'm just giving you my actually passion view is that why wouldn't you have some of that in precious metals? Interest rates went lower in 2015-16. Look what gold has done in that time frame. Is it going to keep going? Maybe not at the same velocity. Maybe it's going to rest. Maybe you come into the market and wait for a bit of a pullback. But you should, it is wise to, and I think it's necessary to have that safe haven. I've got it.
Darren?
Well, I don't know if there's much more to add. I mean, I think Michael's covered it off. I definitely agree with Michael. Obviously, we see cycles when it comes to the commodities, and I think it's pretty clear we're early days here yet with the gold market. I'd maybe just share a little story that kind of was directly related to Michael's comment. I was in Switzerland here maybe about 3 months ago, and I was chatting with a fund manager who was a shareholder of ours, And he was sharing with me that in Switzerland, an example with regards to negative rates or zero rates, the Bank of Switzerland's overnight rate is negative 75 basis points. And so for banks that are effectively depositing their money overnight, they get negative 75 basis points. There's less money in the morning than there was at night. And so how are they trying to deal with that? Well, they're effectively trying to get as much of that money out as they can in the form of mortgages. And they're actually got mortgages going out the door at negative 20 basis points. So effectively you can buy the house and you're effectively, your equity increases just by kind of standing still. That doesn't seem like a normal sort of environment. And I think, to your point, you want to have access to at least some of your portfolio and things for a rainy day. And I think there's a few rainy days that could be coming.
Thanks. And Scott from Canark.
So I'll elaborate a little bit further on Michael's comment. I agree with everything that he said. And if you look at the current interest rate environment, you can take a step back and say, how long is this going to continue? How long will this opportunity exist for commodities and specifically for gold? If you look at the U.S. economy right now, we've never seen a higher debt level than where we are at today in terms of the trillions of dollars of debt in the U.S. And it's the same with other countries around the world. The current U.S. debt to GDP stands at 106% right now. We haven't seen it that high since before the Great Depression. So given that the debt level in the system is so high, the system itself cannot take on higher interest rates. And therefore, inherently, the U.S. cannot raise interest rates, just like many of the European countries that have been mentioned. So I don't have a crystal ball, but I would predict that we will not see rising interest rates for at least the next few years, which is one of the components of the recipe for a higher gold price. Maybe just something else to add to that. Over the last 10 years, we've seen net government buying of physical gold bullion, particularly in China and Russia. So that component of the demand side, I don't think is necessarily going to disappear. And as investors, if we look at opportunities to play the gold space, if you believe we are in a bull market, one thing that gives you direct exposure to leveraging that is, of course, the equities, and we all run gold companies here and silver companies. But one thing I do encourage investors to look at is the ETF space, which does snatch up a lot of the capital that's available to the junior mining space. I was reading through a couple of prospectuses on ETFs, and you have to be very careful with counterparty risk. If people all decided at once they wanted to cash in their ETF shares for gold, there's very few ETFs that are actually 100% backed. Most of them are in that 10 to 20% range. So that's my recommendation, is either gold equities or physical gold itself.
It's an interesting question. One of the great blessings in my life is that I have two kids. One of them is 14 and one of them is 11 now. And my daughter actually asked me the other day, I guess they're getting some sort of an initial introduction to economics in school. And she asked me about metals, obviously knowing that Great Bear has found a lot of gold in the ground. So I actually told her a bit of a story, and I'll make that really succinct right now, but it's about the security of having something that isn't a form of credit, it's a form of money. And it goes back to my great-grandfather in World War I, was a pilot with the British Air Force. He was actually a Belgian guy, but when the Germans invaded Belgium, he joined the British Air Force because he wanted to get back at the guys that invaded the country. Now, that made him something of a war hero. He's actually buried with full honors in a cemetery there in just outside of Antwerp. But one of the things that he was more famous for later in life was being one of the largest diamond importers in Europe. Certainly in Belgium, it was one of the big cutting centers at the time, which was a great achievement for a Flemish guy that wasn't part of some sort of diamond family or anything. And the reason that he was able to get through World War II effectively with some of his wealth intact is that wealth was in diamonds. Now, when the Germans came in and invaded the country, he was one of the first guys in that area that they rounded up because of the war record. So he ended up in an interrogation room with a bunch of Gestapo. and managed to survive that process because, number one, he could make it worth their while to keep him alive. And number two, I guess there was some respect early on in the war that they would, respect the old enemy, right, of which he was one. So, I was looking at it the other day, and, at my house, we have, for instance, there's a chunk of silver that I got recently, which is a 10-ounce silver bar. It was a gift from one of the investment groups that we've done some work with. And I remember showing it to my kids, and I said, guys, I hope you realize that this silver is the only real money in our house. And I think, when times of risk are upon us, the coronavirus, I don't know how that turns out. I imagine it'll all be fine. But the financial risk and the political risk that we see right now, when the lights go out, I would rather be in the position of having something physical in my hand that I can take to advantage to keep my family safe than, say, like a cryptocurrency or something else that doesn't really exist. So I look at it that way, and it's a very simplistic viewpoint, but it's worked well for my family in the past, and it's the sort of thing I think everybody should have a bit of on hand, just in case the proverbial poop hits the fan.
Thanks, Chris. So we'll stay with you, Chris, on the second question. And we've had an overview of gold, so let's move now to the companies. What's your plan to create shareholder value?
We've had a simple philosophy right from the start with Great Bear, and that was to align ourselves with shareholders. So if you look at the share structure in the company now, we only have about 46 million shares issued and outstanding. We're trading at somewhere between $8.50 and $9 a share. We've done really well for our shareholders, and the reason is, we are shareholders, right? So I've bought all of my stock in the markets and in private placements, so I'm fully aligned with basically all of our shareholder base. And in order for us to do well as management, we have to see share price performance. It's raw performance-based. We need to see that happen. So this year we have a $21 million drill program. We managed to raise the money for that program by issuing 2 million shares in the public market. So we're sort of to the point now, based on the size of the gold discovery, that we're not diluting very much when we do more work. And I think that's a really good recipe, is we've been lucky, we acknowledge it. I mean, we had good ideas and good science, but we've also had good fortune, and we're going to take full advantage to translate as much of that good fortune into share price performance as we can. Our stock chart, I mean, it shows how that's been going. I think there's way more exploration upside on the project, and we don't need to raise money inside of this year. So, I mean, you'll see 250 to 350 drill holes over 2020. And there's very few other companies. I think it's one of the biggest exploration programs in the world. So follow the news, follow the drill results. The money that we raise turns into money in the ground, and it's been a good formula so far. I'd anticipate it could continue to be so.
Great. Thank you. And we'll move to Scott at Canark. How are you going to create value for Canark shareholders?
So if we look at the trend we're experiencing right now in the gold price, going back to March, we've gone from, say, 1,300 to almost 1,600. And that momentum in the gold price has yet to fully trickle down to the junior market. So what you often see with the gold price is that it is a cascade effect. So we've seen a rising gold price. The attention is drawn to the equities in the seniors, then down to the mid-tiers, and then down to the junior producers, and then down to the explorers. So Canark is a junior explorer with a 15 million market cap. So we're not a large market cap company, which means we're highly leveraged to a discovery. So the way that we think we can create shareholder value is to be out there exploring on new properties, just like Great Bear did 3 years ago. They made a high-grade discovery. Our aspiration is to make a high-grade discovery. In addition to that, we also have our new Polaris project in British Columbia that has a preliminary economic assessment on it, very robust economics. That is an M&A target right there. So Canark is a takeout target, and I think as we continue to see a rising gold price, you'll see more M&A at the senior level, and again, another cascade effect where we'll start to see M&A at the junior development level as well.
Thank you, Scott. And now Darren at Bluestone.
Yeah, thanks, Brad. So Bluestone Resources, we were fortunate 2.5 years ago. I suspect this room might have been a lot smaller if we're talking about gold 2.5 years ago as well. So, but we were fortunate 2.5 years ago to acquire a very advanced asset that had really had more than $200 million invested in it over a period of more than 10 years by Goldcorp, and prior to that, Glamis. This is an asset that's one of the highest grade undeveloped gold projects out there today. We're backed by some of the best and most well-known investors in the space, including the Lundin family, and Jack Lundin, who I think is here somewhere, is our recently appointed CEO as well. And this is one of those unique opportunities where often in terms of discoveries, and Chris talked about it earlier, I mean, they've made arguably, I think, probably the best discovery in the gold space in the last 12 months globally. And obviously it's had a very strong sort of performance on the back of that. Mother Nature's not making any more of these deposits. They're hard to come by, and we've been fortunate that effectively we've kind of hit the fast forward button on the CD player for the first 13 years because Goldcorp effectively had put all the dollars in earlier, and we're now on the verge of putting the financing in place, and we'll start our development activities this year. This project, if we're here in a couple of years' time, so say 2022, will produce more free cash flow in the first year of annual production than the market cap today. That's a good business, whether it's gold or tennis shoes. That's a good business, and so that's really how we're creating value. And I think 130% of our time is focused on really moving from that developer phase to build the mine, to bring the mine on, and really to create value not only for our shareholders but our many stakeholders as well.
Great. And Michael, you're in the business of selling gold. Why don't you tell us about Border Gold?
Well, we started it, as I said, 47 years ago. And I'm just going to take a quick 10 or 15 seconds to comment on my friends here to the left. A lot of the junior gold companies are not making it so well right now because they didn't do their homework, their housekeeping, their cleaning out. They didn't take care of their companies. When gold went down in 2014, 15, 16, to my left are three gentlemen who have taken care of their companies. I can't comment on what's in their companies, but I can certainly comment on the fact that they're going to make sure that there's value for shareholders, which a lot of junior companies in the past have not done. Border Gold basically buys and sells gold, silver, some platinum, but mostly gold and silver, and we do it on a spread. We're not owners of gold. I'm an owner of gold. My son Robert's an owner of gold, but we are not in the business of owning. We're in the business of buying and selling, and we work on a spread. To us, the best product is probably the 1 ounce gold maple leaf. And the spread between buy and sell, now think about this for a minute. It's a $2,000 Canadian item, and the difference between buying and selling, you coming in and selling it to us, or coming in and buying from us, is $60. That's a very small spread. And that spread is going to narrow, and the buy price is going to go up towards the spot price of gold as we go along and gold gets more popular, gold becomes the product that people want, the spread narrows. But $60 is almost at this level, it's historically small, the difference between buy and sell. So if you're buying probably at this rate, $40 or $50 over spot. And if you're going to sell, you're going to sell at $20 or $30 under spot. So it's a very narrow range between buy and sell. The fact is you've got to wrap your mind around that $2,000 is not a lot of money today with what's going on in the world for an ounce of gold. And the way I look at it, view it, is that it's only got one place to go, and that's higher, because all of the dynamics are in place. There are no dynamics in place right now to drop the gold market. We talked about geopolitical, and the interest rates, the fact that cash isn't earning you anything, those are all reasons that you should own some gold, and you should own it now because the spread between buy and sell is so narrow.
Thank you very much, Michael. So before we launch into our third and final question, given that Michael's a special guest and he has a special business, I have a special question to get started on this next round. Before I go there, though, I want to preview it with a brief story. I'm in the silver business. The earliest example of monetary debasement that I could find in the history of gold and silver as money is the Roman denarius coin. In 260 BC, The 4-gram denarius coin was 95% silver and just a tiny little bit of bronze. By 260 AD, with the decline of the Roman Empire and with the exhaustion of Roman silver reserves, the denarius coin had 5% silver. 4-gram coin had 5% silver, and the rest of it was bronze. Part of the reason why the Roman Empire disappeared was that the trade with their colonies was based on their currency. And as they debased their own currency, the colonies finally said no. And so there's an area actually in the corner of Slovakia and Germany and Poland, and the new currency, just around 262 AD, that was pure silver, came out of that region, and it was called the thaler, and that's where the word dollar comes from. So this is my first example of monetary debasement. In a somewhat related question, Michael, we've seen the US Fed intervene in the overnight bank market since September on an almost weekly basis. What does that mean, and what's going on?
Well, it means that the Fed is in the marketplace. They're keeping liquidity in the marketplace. The U.S. is taking on a tremendous amount of unprecedented debt. When you see that the deficit this year, not the debt, the deficit is going to be $1 trillion plus. This is the Fed getting into the market, making sure that there is liquidity in the market, but just stop and take a step back and ask yourself, what's backing it? It's paper. And that's okay as long as everything is going along as it should, as long as retail sales are good, as long as business investment is good, as long as things are humming in the economy. But you've got a time now when the stock market is, I would think, at excessive highs. Not to say it's not going to go higher. You've got debt that people are taking on personally because you can go out right now in Canada and you can get a mortgage, a 5-year fixed rate if you're in good shape financially for about 2.59%. You can go out and borrow money at prime at 4.5%. In other words, money basically, of course it's been cheaper, but not much. But when you have that kind of liquidity in the system, nothing behind it, when something turns, something is the catalyst. When you've got nothing behind it, when there's nothing underneath to catch it, then you've got a situation where you should have something as a safety net for it. So, stock market going higher? Sure. Things going to be good economically? Sure. And they will be until they aren't.
Thanks, Michael. So a different question for our 3 resource companies. We're drilling deeper and deeper now from the commodity level to the company level. Our last question is basically, what are your main catalysts this year? How do you create value this year?
Yeah, you bet. Thanks, Brad. Well, I mean, just to follow on the earlier discussion, I guess, or the earlier point that I was making before, I mean, we're busy trying to build a gold mine. And so I think in terms of key catalysts for us at Bluestone Resources really is that, last week we announced a $30 million bridge facility that really will be taken out with the project debt that we're in the place of putting together with 5 international financial institutions. And really on the back of that, getting into now to the optimization work, the engineering work, starting to place long lead time items to build a mine, and ultimately then move through that phase from developer, and then ultimately in the next couple of years become a producer. So there's a lot happening now. I think there's for Bluestone, you look at many of the peers over the last call it 3 to 4 years, and it's those companies that have been able to demonstrate the ability to really move from the developer phase, get the finance in place, and then bring those mines on that have seen their share prices move up by 100 and 200 and 250%. I'm not saying that's what's going to happen with Bluestone, but I think that we can see the size of the prize, and when you move from that developer phase into the cash flow, particularly when you have an asset that's going to generate as much free cash flow in its first year of annual production as the market cap, there's lots for us to stay focused on.
Great. Thank you, Darren. And Scott at Canark, what's going on this year?
Yeah, with Canark, as mentioned in my presentation, we will be drilling on a minimum of 2, if not 3 projects this year. We are hoping for a high-grade discovery. As mentioned, these are projects that are more grassroots that have the potential for a district scale or high-impact discovery. And we've seen some very strong success stories in the market like Great Bear, GT Gold, West Haven, and companies that are out there looking for new deposits that discover high grade in top mining jurisdictions such as Canada and the US. They are rewarded in the market. And you're not going to get exposure to that unless you're a shareholder of these companies. And you can literally be looking at 10 to 20 to 30x returns on these type of investments, because when a high grade discovery is made, you see a strong appreciation in the share price, and that's usually followed by a very strong financing interest to further develop that project and to keep drilling that project out. So for Canark, we will be putting metal in the ground, drilling on our new projects, and watch for our news, and hopefully we do have a new discovery. In addition to that, we've put out a very robust PEA on our new Polaris project in BC, very high grade, 10 grams per ton. M&A activity, I think, will be increasing this year with a rising gold price. And the projects that get snatched up are usually higher grade projects in top mining jurisdictions. So there could be a busy year for Canark 2020.
Great. And last but not least, Chris, the Great Bear.
Yeah, thanks, Scott. I mean, you said half of what I was going to say. So we've definitely benefited from that formula that Scott just laid out of premier jurisdiction, high-grade gold discovery going right to surface. So, I mean, there's 2 things that we're going to do inside 2020 to really generate that specific shareholder value. Number 1 is define exactly what we have. The precedents that we've seen, which seem to have a similar type of geology and a similar potential of size, and it is just potential, it's a new discovery with us, but we're having to walk this fine line of promotion between not over-promoting, but also being realistic about the scope of what we've discovered. So one of the deposits we throw the name around on, and we do it deliberately because the geology is similar and the spatial footprint is similar, is the Hemlo deposit, which was discovered in the early 1980s. And if there's a number of people in the room here that'll remember that discovery, it's now owned by Barrick. It produced over 20 million ounces of gold. I don't yet know how much we have on our Dixie property. That's up to us to drill off. But the value today of a discovery like that is obviously much bigger than what Great Bear's current value is. So as we flesh it out with our fully funded drill program, we should be able to capture more and more of that value over time, provided it keeps going well. The other thing that we're doing, though, which is a little bit unusual at our stage, is that we've announced that we're going to spin out a 2% net smelter royalty to our shareholders sometime in the very near future. We just put out news about this, I believe it was last week. And that means if you own a share of Great Bear between now and, say, a date a few months from now, you'll also get a spin-out share in what will be a publicly distributed but initially private company, non-listed company, that'll own this 2% royalty. The reason that we're doing that is really because we want to keep a hold on our own fate as long as we can. And Great Bear is a company I've been involved with for 10 years now. So a decade of my life has been devoted to growing this company into the state that it is now. And when I look at what we have on our hands, I just think if it's as good as what we think it is, if the drill results continue to come back positive, there aren't many discoveries like this or any discoveries like this that are owned and operated by the little junior company that found it. They're all exclusively owned and operated by bigger mining companies. If that's the case, somebody may buy it or buy us, and in which case, how do we keep exposure for the Great Bear shareholder of the future value if it goes into production? And these royalties, like you look at huge companies, multi-billion-dollar assets like Franco-Nevada, they all got started off of tier 1 producing gold assets. And I think, you know, if that's what we have here, it's a way that we could really benefit our shareholders over the long term. So just look at our news flow about that, and that's something that's going to be coming up in the near future as well.
Wonderful. Thank you, Chris. So just before we go to questions, I just would like to summarize that we have here on our panel 4 very diverse ways to own gold in the portfolio. Michael's in the business of selling gold, and physical gold, there's nothing comparable. Everybody should own physical gold. I own physical gold. Darren's building a mine, and he's projecting future production, future cash flow, future earnings, and also the possibility of a friendly buyout from a larger company at a premium in the share price. So very interesting value creation thesis. Scott actually has two ways to make money for Canark. He has a fully drilled out million-ounce deposit in northern BC with very robust economics that could be either partnered, sold, or ultimately attract a buyer for the company. Plus, he's restarted effectively elephant hunting because he's got a good treasury and 2 projects to drill this summer. And last but not least, Chris, probably the newest company in the group, the newest discovery in the group, very exciting discovery. And as he said in his own words, the possibility to not only find a lot of gold in a short period of time, but with neighbors within 100 kilometers away actively looking for gold deposits, we can see, I think, a clear path to a possible takeout of Great Bear down the road. So that's my summary. We have a few minutes for questions, and in the front here.
It's wonderful to have 47 years sitting in front of us, and I'd like to take you back to that time, which was pretty much when Nixon took us off the gold standard. And also, do you remember the value of the GDP and the M2 money supply? I think we haven't hit $1 trillion yet. But today, we're sitting at 72 trillion in M2, and we're sitting at 23 trillion in GDP. M2 is 3.5 times what we actually produce now than it was 47 years ago. The message being that is gold to be valued in currencies, or is gold to be valued in what it will purchase in the future, such as food, shelter, energy, communications that we need to live? I would hold that valuing money in gold, in money or currencies, is not as good as getting our head adjusted to the true value of gold, which has no counterparty risk.
Just quickly, really quickly. I don't disagree with you that you have to own gold for a lot of the reasons. Currencies are a medium of exchange, no matter which way you look. Your medium of exchange will buy your groceries. Your gold that you sell will give you that medium of exchange, even if it's an enormous amount. You still have to have a way to do business. Bartering is not going to work. So you've got to bartering or using your gold against. People do not understand who are selling you something what a half an ounce of gold is or what an ounce of gold is, but they do understand what $5,000 is or 10,000 or whatever that number is at the time. So yes, you're right, but you still have to have that medium of exchange.
Thank you, Michael. I'm going to reserve the last word, and it's related to this. There is another way to look at gold. We talk about gold priced in US dollars or euros or Canadian dollars. But really, the more appropriate way to look at the dollar is priced in gold ounces. And if you go back to 1970, the purchasing power of the dollar is down 95% or more. So if you look at gold as a unit of the dollar rather than the other way around, then I think it's a real wake-up call to the value of gold in the portfolio. Thank you very much. Thank you for the panelists. Thank you for attending.